If you've been an investor in the stock market, you may have noticed that over time, your account has likely gone up, and it could go up substantially if you're invested properly. Now, while the stock market has offered a lot of growth over the years, it's susceptible to corrections over time as well. While these corrections can be inevitable, there are certain things that you can do to make sure that you're able to take advantage of down market scenarios. If history is a guide, the market has responded each and every single time a correction has taken place. Here are 6 things that you can be considering. The first one is to consider what's known as tax loss harvesting. Tax loss harvesting will apply to non-qualified accounts. Whenever the market experiences a loss, and thus the securities that you're holding within the account experience a loss, you may notice that there's actually a loss of principal that takes place. And when this happens, there are generally 2 things that you can do. Number 1 would be to continue to hold the asset and hope that it does rebound, which it certainly is possible that it can do that. The other thing that you can do is evaluate your total portfolio and see if you can sell that asset at a loss and sell a corresponding asset that has a gain, thus potentially canceling each other out and then resetting the cost basis inside of both of those accounts. If you offset a gain with a loss, there would be no tax that would be due so long as it's a dollar for dollar match. Now, if you do have losses that actually exceed your gains, you can then write off $3,000 per year off of your income. This can actually offset ordinary income. So if you take out an IRA withdrawal, if your Social Security is taxable, or if you have income that you're bringing in from an earned income standpoint, this would be one way that you can actually lower the taxable income in the given tax year in which you sell off the asset that had a loss. And then any remaining losses in excess of that $3,000 can also be written off in future tax years. One thing that you want to avoid, though, is what's known as a wash sale. So if you sell off an asset that is either the same asset or a substantially identical asset, and then repurchase it within 30 days, or if you repurchase it 30 days prior to your sale, you're not able to deduct that as a loss on your tax return. In a down market environment, if you have a newer asset that you're holding and it experiences a loss of principal, tax loss harvesting can be one thing that you can at least consider in a down market. The next thing that you can consider is what's known as a Roth conversion. Now, we've covered this in previous videos and talked quite a bit on Roth conversions, but an opportune time for a Roth conversion could be when a sudden market correction takes place. Let's first cover what a Roth conversion is. It's when you take pre-tax dollars and convert them to Roth assets. In the year in which you do the conversion, the income tax would be due in which you have to pay. However, what can really be advantageous for an investor is in a down market environment when the pre-tax account takes a major hit. If you're able to do a Roth conversion and it makes sense for your situation, any of the corresponding growth then would be growing tax deferred, and when you take it out, it can be taken tax free. Thus, you could be purchasing the Roth asset at a market low. Let's quickly walk through an example of this. Donald Donaldson has $500,000 in a pre-tax IRA account. If you remember back in 2020, when the COVID crash occurred, it occurred rather quickly. If he was invested solely in the S&P 500, he would have felt a 34% drop in March of 2020. Now, had he converted $100,000 from his pre-tax account to his Roth account at the bottoming out in March of 2020, he would have noticed that by the end of the year, a big jump would have occurred, and that $100,000 would have been invested inside of his Roth account. The market recovered rather quickly in 2020, thus resulting in about a 70% increase. So if Donald was in the 22% tax bracket, he would have owed $22,000 of tax on the conversion. But that same $100,000 that he would have converted from pre-tax to Roth would have grown by that 70%, thus giving him $170,000 at the end of the year. The difference between the $170,000 in his Roth versus the pre-tax account is assuming he would have satisfied the other 5-year rules. The dollars inside of his Roth account would now be tax-free and eligible for a tax-free withdrawal, assuming that he has satisfied the other 5-year rules. Better yet, that $170,000 that is in his account, if it continues to grow over time, will continue to grow tax-free, thus giving him a pretty sizable amount of growth in just the bottoming out of the downward cycle, but any future growth could also be done tax-free. It creates a great opportunity for him to consider in a down market environment. The third thing that you should be considering, especially if you're a recent retiree or a soon-to-be retiree, is creating a non-correlated account for withdrawals in down markets. And why this would be important is because if you are taking from an account or you're expected to be taking from an account, you don't necessarily want to be taking from an account that's already bleeding. And yes, while the market may average 6 to 8% if you're invested in a proper portfolio over a 5, 10, 15, 30-year time period, what you'll also notice is that that 6 to 8% is by no means guaranteed each and every year. It may be best to consider actually utilizing another non-correlated account to continue your income as is, and thus creating an opportunity where that stock account would be able to rebound with the market growth. This non-correlated account can come from a number of different sources. One of the most common is cash, whether you have a money market, a large amount in your savings account. It could also occur from certain bonds as well. Now, there is no such thing as a riskless asset. Usually, the stock market will outperform those types of accounts, but you want to hold these accounts for when the market is correcting. Instead of taking an account that is already down, you're then able to take from an account which maybe isn't losing as much in principal, but you're able to keep your income steady and that you're able to keep predictive cash flow, as opposed to taking from an account that's already down. Creating a non-correlated account or having some of these dollars set aside for when the market does correct can really benefit a retiree for the unknowns in retirement, specifically around stock market investing. The fourth thing that you can and should be looking to do is considering what's known as a guardrails approach. And this could be adjusting some of the income that you're able to receive from month to month or year to year, however you are taking income. What you're seeing here is an example of when the market does correct, if you scale back some of the income, you're putting less stress on the portfolio to continue to provide income while also grow over time. When the account takes a hit, if you scale back some of that income, you can allow the account to more or less normalize. So when the stock market and your account in conjunction end up recovering, you're then able to take out more income, thus giving your account a much needed boost when the market is down. Now, taking a pay cut is never fun, whether you're working or in retirement, but it could be necessary if you want to make sure that your account is able to withstand the test of time, which is why it's important to review and readjust your retirement spending. And budgeting in retirement is no different than budgeting while you're working. You want to make sure that you consistently have positive cash flow. Now, when it comes to the expenses in retirement, it's usually a good idea to break them up into essential expenses, which you have to pay. I'm putting in the description below a link that you can actually download one of these spreadsheets, which can break off the essential and discretionary expenses. Now, every retiree is different. For some retirees, they may feel that some expenses are essential and others are discretionary, but giving yourself a buffer within the discretionary and essential expenses can also give you a great opportunity to make sure that you're not strictly beholden to some of these expenses that take place when the market is down. The sixth thing to consider in a down market environment is making sure that you're staying flexible with your retirement plans. And while it definitely includes some of the cash flow that we just talked about and withdrawals that you take from your accounts, it may also include things such as other income that you could be bringing in. Common ones in retirement do include Social Security, possibly a pension, or part-time work. These different opportunities can also alleviate some of the portfolio withdrawals that you may be experiencing. Now, for some of you, you may be saying that going back to work is not an option. You may already be collecting Social Security or pension, so there could be less flexibility for those of you that are out there that are currently utilizing those types of incomes. But understanding that in down market environments, when they occur, if you're able to either work part-time, work an extra year, and the stock market takes a significant hit, that could buy you some time in your later years in retirement that you're able then to make sure that you're not going to experience the market lows and quickly deplete your retirement accounts in the early years of retirement. The takeaway should be that planning is best utilized for this. There are going to be times when the market is down and you could see a sudden drop like in COVID 2020 when we noticed that it was within the year. The S&P 500 ended up positive that year despite a massive correction within the year. Check out HyperionFP.com if you'd like to learn more about how we help retirees live their best retirement. But also make sure that you check out these two videos that I'm linking to right now to make sure that you understand whether it be Social Security you're looking to maximize or making sure that your income is protected in retirement for your portfolio plan, that you're able to put yourself in position that you're the one in control.